Are we in a new tech bubble? Are we heading for another Y2K collapse? Join us this week as we talk with a portfolio manager, Mr. Jan Naismith and Label Sternbach, and we'll talk about their opinions on the next Label on Fire.
Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
In Label, we've got portfolio manager Jan Naismith with Algo IQ Capital. But tell us a little bit more about how you two got together and why we've invited Jan here today.
Yeah, so one of the things that I do in my day job, right, as many of I run a fintech platform. One of the things that I do in my day job is I get to meet very interesting people like Jan. And what'll happen is we're constantly getting introduced to portfolio managers and economists and all kinds of people in the plumbing of the financial industry. And when sometimes I'll get called in and people ask me, well, is what they're saying real? I don't understand what they're talking about, but, can you tell me, can you talk to them and tell me, does it make sense what they're doing? Is it right? Is it something that we can fit into our client's portfolio? And so Jan is one of those rare gems in the financial industry where his view on and the way he looks at finance is very different than everyone else. Most people, they'll read the Wall Street Journal and the Financial Times, and they'll be like, oh, this is my opinion. This is that opinion. Jan, was being a musical composer among his many other talents, sees kind of the rhythm and the heartbeat of the financial industry. And so he sees patterns in it that other people do not. And that has allowed him for 30 plus years, 40 years almost, right, to create financial instruments and investment philosophies that create different outcomes than what your traditional investments have. And so we were chatting the other day and Jan brought up the similarities to Y2K and what's happening. And so I thought it would be great to have him on the show to talk about, with his breadth of experience and his viewpoint, right? What does he see the world where we stand today and what the future is?
Yeah, thank you for having me on. I really appreciate this. And thanks for the introduction, Label. What I'm saying is I somewhat divorced myself from CNBC and Bloomberg and all the talking heads and all that stuff back in about 2000 because of WorldCom and a number of different firms that were cooking the books and so forth. So I lost trust in what I was actually hearing. So what I really did at that point in time, I'm a decent math guy, and I decided to concentrate on price. All right. Now, price is cool because you can do all kinds of stuff with price, but it tells a lot of stories. So it's not necessarily thematic what's going on. I think what's happening now with AI and so forth really kind of mirrors, it reminds me of the days I was buying Sun Microsystems and Cisco and things like that back in the mid-90s or early 90s. And now I see the onset of the same type of theme, meaning it's just different types of things that are in the AI and so forth. And the problem is, from a mathematical viewpoint, what I did just for fun to quantify my feelings and test them, if you will, is look back at the last 248 weeks just for fun. I did that this weekend. And that's the low that we had in March of 2020 during the COVID scare, right at the onset of the COVID scare. And we're up 165% on the S&P 500 since then. So I thought, let's go back to 1960, right? And let's see how many times this has happened. It's happened 4 different times, which is pretty rare. If you take that whole time frame, that's very rare. So what happened during those time frames? Well,
wait, let me just stop you right there. So yeah, are you saying that in the last 60 years that there has only been 4 times where we've had a run up of so many back-to-back high growth years?
Yeah, that's correct. And in 1998, we had a period of time where we came off a low of 2000. So if we go back 248 weeks, we're talking about 4 3/4 years. So that was the beneficiary of the fall of 2002 going into March of 2003. So we did have a few times where it reached that point, but in terms of clusters, if you will, there's only been 4 times. So what I did then is go ahead and say, okay, what happens when we have that kind of a run up, because we've had a huge run up since the low of 2020. And the answer is that we always have some sort of decline, right? Not long after we hit those periods of time. Now, sometimes we'll have a 15, 20% run up from here. But ultimately, one of the most ironic one was the week before the 87 crash. Now, what's the odds of that? And that there just happens to be a statistical anomaly there. But so it gives me concern that things are so good, they can't possibly go wrong. And unfortunately, that's not the truth. We will have some period of time where we need to use our risk management techniques and really celebrate what's happened here, but be very cognizant of what could happen.
It reminds me a little bit of Warren Buffett saying, right, that when the tide goes out, you see who's swimming without trunks, right?
Yeah. Well, you don't want to see me do that, but anyway. So that's just it, Label. I mentioned that it feels like 99. I was there at 99. I'd already been in the business for quite a long time before 99. And I hadn't seen much exuberance as much as I did at the end of 99 until now.
So what are you advising right now? Is there a collapse on the way? And if there is, Jan, how do we start to prepare for it?
I don't know if I don't know if collapse is the right word. I think there's going to be a settling down. It wouldn't surprise me to see a 15, 20% pullback, not a 50% pullback like we had in 01 or 00 or even 87. That wasn't even a 50% pullback. We had a real crisis in 07 going into 08 that was basically broadcasted in January of 07 that things were going to get kind of ugly, and they sure did. I don't really see that at this point, but what I do see is that if you've collected a heck of a lot of gain, there's no reason to go down 20% just because the market is. So what you do is you start taking things off the shelf that you've had on there if you've caught that ride, and you start using other items. And so you go, the more uncorrelated you become over this next, period of time, which I'd say in my case, I'm starting to do it now, then we can hopefully bypass having decay in the portfolio that we might see in the equity markets.
So
or simply go sidelines. There's nothing wrong with the sidelines. Ultra short government bonds right now are paying 5%. That's not bad.
So what I'm hearing is we're facing a double whammy, right? We've got, like you mentioned, the sidelines, right? So you've got, on the one hand, you got equities that are ripe for a pullback, right? So all the growth stuff has to come down at some point. Question is, how hard are they going to come down and how long are they going to come down? That's what
Correct.
And then you've got, on the flip side of that, the safe haven asset, the interest rates, and those are coming down because we're trying to combat inflation, right? And we're trying to, create this soft landing. So you've really got, as a retiree that you're looking for to build that kind of safe haven experience, you're now caught in between two crosswinds, right? And so the question is, where do you go to protect your investments? And it kind of reminds me of something that we've talked about a while of your harvester, right? Where, something that we talk about with our investors was we tell them, right, you got to have, you got to have your shields, right? Where you have the money that you're living off of for the next few years. And that kind of, protects the money that's for the near future and for the long-term future. And you need to be harvesting those gains, right, to replenish those buckets when it's opportunistic, right? So taking that risk off, you want to talk a little bit more about your take on that?
Yeah, I find we rarely hit all-time highs, meaning that if you go on an end-of-month basis, all-time highs throughout history, you're talking 10% of the time, possibly. When you go to end of week, now you've got more data points where you can pull off gain from the all-time high. But most of the time, the markets are not at all-time highs. They're almost, I don't know the exact number, it's got to be over 80% that they're not, probably 90%. And my thought is, okay, how about on a daily basis? So what I do is that when we hit all-time highs on a daily basis, I know statistically we're not going to be sitting there day after day after day after day after day. So what I do is I scoop a little bit of the froth, if you will, from the all-time high, leave the majority in the portfolio at the all-time high, but scoop some off, put it into something that is much more moderate in risk or actually low risk. And what that does, it creates a smoothing pattern or smoothing effect on the portfolio as a whole, and it works very well. So I can keep my drawdowns and volatility very low compared to what the market's giving us and still outperform the market. So
you've got guardrails set up to protect you in either way. So you're not all in, but you're certainly not all out, and your trunks are still up when the time.
Well, yes. And the thing is, when those guardrails are breached, then I go to the sidelines, and I'm very tactical. And I used to be president of a very tactical organization. So I believe in trying to keep the drawdown and the volatility as low as I possibly can.
When you talk to hedge fund managers, they're talking all about risk. They're talking about what their hottest stock is, and they're glorified impressive for the future. You very rarely hear them talk about the risks and taking risk off the table. And it's kind of one of the unique things. Yana is just launched a brand new hedge fund specifically geared for retirees, right? And for people who are worried about the future and are looking for that growth potential, because there's always growth potential, but not if you're just buy and hold and being able to kind of harvest those gains. So Jan, tell us a little bit about Algo IQ, what you're doing, and where people can learn more information about you if they want to learn more about your fund.
Sure. AlgoIQCapital.com. It's a pretty new site. This is a new fund, but it's based on technology that I've been using for a long time. I have some bond indexes. I'm an index provider with Smooth Sailing. And if you go and look at the returns of Smooth Sailing on Bloomberg, you'll see that they're very sleepy, but they're going in the right direction. All right. So in our case, what I've done is I've taken the same type of technology that I applied to the bond indexes, and they've been modernized because those indexes have been around for a while. So the idea is that what I'm doing is, that's made it more unique, is that I am my own worst, what's the best way of putting it? I'm my own cop, if you will, meaning that when things are not behaving, I've developed a way to detect that and be able to correct it, which makes it very unique, because a lot of times the managers will just simply run it down or sit on the sidelines and cower. In my case, if what we're doing is not hitting our goals, which is very lofty, then we have the ability to correct that behavior. And that assures us, or helps us realize that we will be hitting our all-time highs as often as we can, or at least we're trying to do that. That's our ultimate goal. And that helps retirees sleep at night as far as I'm concerned.
And again, what's that website?
AlgoIQCapital.com.
All right. Well, that's great information. And the other website, of course, yieldsforyou.com. Gents, thank you so much. I'm Freddie Bell, tipping my hat to you, and we'll see you next time.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell, or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.